Welcome to Market Pulse 24/7's, bringing you the latest from the world of finance. It was another banner day on Wall Street, a session defined by relentless optimism and record-breaking performance. Both the S&P 500 and the tech-heavy Nasdaq composite surged to fresh all-time highs, with the Dow Jones Industrial Average also posting substantial gains ins after Jen. Investors pushed stocks decisively higher, embracing a narrative of economic strength and corporate resilience. So, what was the fuel for today's powerful rally? The market was ignited by a potent cocktail of better-than-expected corporate earnings and a pair of robust economic reports that painted a surprisingly strong picture of the U.S. economy. This wave of positive news effectively washed away, at least for today, the persistent concerns over international trade disputes and global growth forecasts. From a technical perspective, the market's posture is undeniably strong. Breaking through prior resistance levels to set new records is a significant bullish signal. However, it's crucial to note that this powerful multi-day surge has pushed key momentum indicators into what analysts call overbought territory. Now, this doesn't automatically mean a sharp reversal is imminent. Instead, think of it as a car engine that's been running hot. It might need to cool down. It suggests the market could be due for a period of consolidation or a healthy, modest pullback as some investors look to take profits. The key will be whether the new highs can hold and transform from a ceiling into a new floor of support. We'll be watching those levels very closely in the coming sessions. The Dow Jones Industrial Average added a solid 263 points to its value, closing at 44,529 and a second. Technically, the index is in a textbook uptrend. The price is trading comfortably above both its 50-day and 200-day moving averages, which are widely followed indicators of an asset's medium and long-term trend. This positioning is a classic bullish sign. Furthermore, momentum indicators like the MACD, moving average convergence divergence, have likely shown a positive crossover, signaling that the upward momentum is accelerating. However, as we mentioned, the rally speed has pushed the Relative Strength Index, or RSI, above the 70 mark. This indicates the index is technically overbought, which could temper short-term enthusiasm. The next major psychological hurdle for the Dow is the 45,000 level, while initial support can be found near the 44,000 mark. The broader market, represented by the S&P 500, had an even more impressive session. It tacked on nearly 0.7%, closing at 6,306.7% by the S&P/. This milestone marks the index's 9th record close just this year, a powerful testament to the underlying strength of this bull run. Similar to the Dow, the S&P is firmly above its key moving averages, confirming the bullish trend. The breakout to new highs is technically very significant. It tells us that buyers are in full control and willing to pay record prices. With this move, immediate resistance is now uncharted territory, with the intraday peak of 6,308 serving as a new ceiling to watch in time X12. Should we see any profit-taking? Analysts are eyeing a band of support between 6,150 and the more psychological 6,200 level to hold. And leading the charge once again was the technology sector. The Nasdaq composite jumped 0.7%, closing at 20,884, its fourth straight record high 6-day. The index was fueled by renewed vigor in the semiconductor space, which we'll touch on later. The technical picture here can be described as one of unbridled bullishness. The uptrend is steep, and momentum indicators like the RSI are flashing deep in overbought territory, even more so than the other indices. While this normally calls for caution, fighting this trend has been a losing battle. The path of least resistance remains higher until the market proves otherwise. The 20,500 level, a recent peak, should now flip to become a solid floor of support for the tech-heavy index. Leading the S&P 500 was the beverage and snack giant PepsiCo, which saw its stock soar an incredible 7.5% 20. The catalyst was a blockbuster quarterly earnings report that decisively beat Wall Street's expectations on both revenue and profit. The company signaled that consumer demand for its products remains robust, and investors responded by devouring the stock on significantly higher than average trading volume. This move sent the stock to a new multi-month high. The positive sentiment was widespread. We also saw impressive strength in financials and industrials. Insurance bellwether Travelers jumped nearly 4%, while railroad operator CSX Corporation gained almost 3.8%. These types of cyclical companies often perform well when investors feel confident about the economic outlook, and today's strong retail sales and jobs data provided exactly that backdrop. Rounding out the top 5, banking giant Citigroup added over 3%. Although the prospect of a resilient consumer is good news for banks, as it suggests continued spending and borrowing. Now, on the other side of the ledger, it wasn't a perfect day for everyone. While the major indices were green, there were pockets of weakness. A definitive list of the biggest S&P 500 losers was sparse, indicating the breadth of the rally. However, by looking at the Nasdaq, we can see where the selling pressure was concentrated. Chipmaker Micron Technology was a notable decliner, falling nearly 3% twon. This appears to be a classic case of sell the news profit-taking. Despite a fantastic earnings report from industry titan TSMC that actually lifted many of its peers, some investors chose to lock in recent gains in high flyers like Micron and semiconductor equipment maker ASML, which also dipped over 1% EDAS. This suggests some rotation within the tech sector rather than a broad-based exit. We also saw some isolated weakness in the biotechnology space, with industry leader Vertex Pharmaceuticals dropping over 1% its place. This move appears to be driven by company-specific factors and not indicative of a wider risk-off sentiment in the market. Overall, the losers list was short and the declines were relatively muted, reinforcing the day's overwhelmingly positive tone. As the heat map illustrates, the leadership today was clear. The standout winning sectors were consumer staples, propelled by that massive gain in PepsiCo. Information technology also had a stellar day, which is no surprise given its massive 31% weighting in the S&P 500 index. Gains in chip makers and software companies provided a powerful tailwind. And as we saw with Citigroup and Travelers, the financial sector was another clear winner, benefiting from the positive economic data Tudy and his group. The laggards were harder to identify, but there were isolated pockets of red, primarily in some biotech and material stocks. Let's put a spotlight on one of the day's winning groups, consumer staples. We can use the XLP exchange-traded fund, which holds stocks like PepsiCo, as a proxy. As you can see on the chart, the sector had a powerful move today, gapping up right from the opening bell and closing near its session high. This move pushed the ETF to a technical breakout, clearing a key resistance level. Its RSI has now jumped into overbought territory, but the MACD indicator is flashing a strong buy signal. It's particularly interesting to see a defensive sector, like consumer staples, rally so strongly alongside cyclical sectors, like tech and financials. This suggests a very broad-based buying appetite in the market today. This brings us to market breadth. The advanced decline line, a technical indicator that measures how many stocks are rising versus falling, was strongly positive today. This is a very healthy sign. It confirms that the record highs in the indices weren't just the result of a few mega-cap stocks doing the heavy lifting, but were supported by widespread participation across the market. Finally, no market analysis is complete without checking in on Wall Street's fear gauge, the VIX. The volatility index finished the day quietly, settling around the 17 level. This is a relatively placid reading. Generally, a low and declining VIX signals complacency and a lack of fear among investors, which is entirely consistent with the market confidently marching to new all-time highs. However, seasoned traders always watch for extremely low VIX levels, as it can sometimes be a contrarian indicator that the market is becoming a little too complacent, making it vulnerable to a sudden shock. As we've emphasized, today's market rally wasn't just built on sentiment, it was built on a solid foundation of strong economic news. Let's quickly break down the key data points that had investors hitting the buy button.